Hi everyone, Mortgage Mark. Let's talk about new construction, meaning you're buying a new home and you're going to set up an escrow account. So an escrow account, if you don't know already, it's basically a piggy bank with your name on it that is set up to help pay for property taxes and the homeowner's insurance when it comes due on an annual basis. So what gets tricky about setting up escrows with new construction is the property tax component. So guys, when you buy a new home and you close on it, and I'm going to pick a month, let's just say it's July. And if you close on this home in July and the home in January and February was a piece of dirt, right? So maybe construction hadn't started or was just about to start. The central appraisal districts, they're going to go out in Texas, at least, they'll go out around February, March time period, and they're going to assess a value. So in January, February, it was going to be dirt. Let's say it's a $30,000, $40,000 piece of dirt at that time. That's what your tax value is going to be based off for the entire year. So at closing, you're going to get from the seller, or in this case the builder, you're going to get tax prorations from January 1st through the closing date in July in this example. So when you set up an escrow account, you can set it up one of two ways. Our recommendation is you set up the escrow account with a big number for property taxes, because when you get done building that home and it's worth, let's call it $400,000, your property taxes next year will be based on $400,000 home. And that's great. But guess what? Again, this tax year, the tax year that you're closing is going to be based on that dirt value, which means there's only going to be like this, it's a really small amount due for this tax year. Well, guys, if you set up an escrow account with that really big number, what's going to happen come tax time is that they're going to just have too much money. They'll pay the taxes, and then when they do an analysis, escrow analysis, back in February or the next February, they'll then give you the refund of whatever excess amount is in there. And then moving forward, everything's kosher. You're good. The taxes are set up the way they should be. There might be a small adjustment, nothing major. But here's the worst case scenario. If you choose plan B or the other option, and you want to set up an escrow account on the lower amount, the raw tax value amount, this year's taxes, when it goes to get paid, it'll be right or very, very close. What's going to happen, guys, is that next year, your payment will continue to be based off that lower dirt value. And that's not good, because all next year, you're going to pay money into this tax escrow account. And then when the tax bill comes due, there's going to be a massive shortage. So in other words, you've paid all this, for a full year, the following year after you close, you're doing it, and you're thinking, well, I'll just have my escrow account updated and pay the full amount come the next year. It doesn't work like that, guys. If the tax bill was adequate and the escrow account was covered, most mortgage servicers won't voluntarily just raise your escrow account. They're heavily regulated by the government, and they can't just charge more because they want to. So you're going to go all this following year paying all this low amount, and then when the escrow analysis comes in, call it a year and a half after closing, they're going to say, yo, you owe us a boatload of money. So at that point, they're going to either say pay up, and by the way, your payment's going up to be what it should be for your taxes and insurance for that escrow account. Or if you don't have that money, we're not only going to increase it by what it should be, we're going to throw another increase on it for the 12 months to basically recapitalize that escrow account for the shortage. So it's a nasty, nasty bill in the mail a year and a half after you close. So if you're not careful, it's a big deal. So guys, new construction escrows, highly recommend from our side. Go ahead and take the kick in the gut at closing and put in more money than you need to at the higher amount, knowing you get it back once they do an escrow analysis the following year. But at least then you're set, right? It's just a nice little present come February or March, you get that money back. I know it's a lot. Watch this video once or twice. If you need to, we'll put, there's an example down below. But it's a very serious matter, guys. We got a lot of folks. One right now in particular, somebody's calling us because their bill went up by like $2,000 almost. So pay attention, know what you're doing, take our advice, plan for the worst, hope for the best, and then you'll be good and you'll be thanking us down the road. Call us if you need us.